January 8th, 4 days from now, $5 billion will be forcibly dumped into the silver market. Not a choice. Not a strategy. A mathematical certainty. JP Morgan confirmed it. Roughly 13% of the entire COMEX market liquidated in 7 days. Passive funds have no alternative. They must sell. The window opens January 8th and closes January 14th. This isn't sentiment. This isn't speculation. This is index mechanics overriding market fundamentals. The forced liquidation machine has already been switched on, and what happens when $5 billion of selling pressure hits a market already at record highs with the lowest liquidity in years? Welcome to boring currency. Now, before we break down exactly what's about to unfold, let me ask you something. You've been around the block a few times, haven't you? You've seen markets climb. You've seen them crash, and you know the real money isn't made by chasing the crowd. It's made by understanding the machinery before it starts moving. So here's what I want from you. Take a second. Scroll down to the subscribe button and click it. Think of it as locking in your seat at the table where real information gets shared. No hype. No nonsense, just the mechanics of how markets actually work. And while you're down there, leave a comment. Tell me where you're watching from today, New York, Singapore, Dubai, Frankfurt. Snorts, I genuinely want to know, because what we're about to discuss touches every market, every currency, and every investor on this planet. Now then, let's talk about what happens when $5 billion becomes a weapon. January 8th. 2026 is not just another trading day. It marks the start of a mechanical process that will reshape silver markets regardless of fundamentals, regardless of sentiment, regardless of what anyone wants. The Bloomberg Commodity Index oversees more than $60 billion in passive investments. Every January, the index rebalances. This year, the rebalance will trigger $5 billion in forced silver selling. The math is straightforward. Silver gained 148% in 2025. That surge pushed silver's weight in the index far beyond target levels. Passive funds tracking the index must restore proper weightings. They don't get a vote. The rules are automatic. The execution is compulsory. When the index says sell, they sell. No discretion. No waiting for better prices. No consideration of market conditions. JP Morgan's commodity research team published the warning in December. Their analysis quantified the coming liquidation with precision. 9% of total COMEX silver open interest will be sold. TD Securities ran the numbers differently, landing at 13%. The exact figure matters less than the certainty. Forced selling is coming. The window's tight, January 8th through January 14th, 7 trading days. Approximately 130,000 COMEX silver contracts must be dumped into the market. To understand why this matters, you have to understand how normal selling differs from forced liquidation. Normal selling is discretionary. An investor studies the market, weighs technical levels, reads sentiment, and then decides whether to sell. If conditions look unfavorable, they wait. If the bid is too low, they hold. If volatility is extreme, they delay. Forced liquidation follows a different playbook. The index rebalancing mechanism doesn't care about market conditions. It executes on schedule. If January 8th arrives during a downturn, it sells anyway. If liquidity is thin, it sells anyway. If prices are sliding, it sells anyway. The mandate is mathematical, not strategic. This creates a predictable problem. Silver futures markets run on finite daily volume. On a normal day, the market can absorb routine buying and selling flows. But when billions of dollars of forced selling get compressed into 7 days, absorption becomes difficult. Market makers see the liquidation coming. They widen bid-ask spreads. They cut the size they're willing to trade. They protect themselves from being run over by the wave. That magnifies price impact. A seller trying to move $5 billion in a typical market might execute gradually, finding buyers at reasonable levels. A seller forced to execute in 7 days faces harsher conditions. Buyers know the selling is coming. They wait. They shade bids lower. They force the seller to come to them. Silver's lower liquidity compared to gold makes this worse. Gold trades in enormous volume globally. Large orders can be absorbed with minimal disruption. Silver markets are smaller. The same-sized order creates bigger price swings. History offers examples. In 2011, silver went through a similar forced liquidation. Margin hikes and profit-taking triggered a cascade. Prices fell 48% in 6 weeks. The current setup carries echoes of that period. Parabolic price rise. Check. Margin requirement increases. Check. Overbought technical conditions? Check. But there's a critical difference In 2011, fundamentals were weakening alongside technical selling. In 2026, fundamentals are strengthening even as technical selling accelerates. The supply-demand deficit is real. Industrial demand is growing. Mine production is declining. The forced selling doesn't change these facts. It simply creates a temporary distortion in price. The CME Group, the exchange where silver futures trade, prepared for the coming volatility. On December 29th, they raised margin requirements. Traders must now post 17% of contract value as margin. This is the highest requirement since the 2011 crash. Back then, margins peaked at 10%. The exchange understands what's coming. Higher margins reduce leverage. They push some traders to close positions. They dampen speculative activity. In theory, that lowers volatility. In practice, it adds another layer of selling pressure. Traders who can't meet higher margin requirements must liquidate. This compounds the index-driven selling. For mining companies, this creates a peculiar situation. Their operational fundamentals remain strong. Production costs are covered comfortably at current prices. Demand for their product remains strong. Yet their stock prices will likely face pressure simply because the metal they produce is being mechanically sold. The gap between business reality and share price can become extreme during events like this. Industrial users of silver face a different set of calculations. Companies that manufacture solar panels, electrical components, and medical devices all need silver. Forced liquidation can hand them a potential opportunity. If prices drop meaningfully during the 7-day window, forward purchases become attractive. Locking in supply at technically depressed levels can deliver cost advantages for months. The challenge is timing. Buy too early and prices may fall further. Wait too long and the liquidation ends with prices rebounding. For long-term investors, the situation demands perspective. Forced selling changes nothing about why they own silver. The snort supply deficit continues. Industrial demand growth continues. The monetary concerns that drive safe haven demand continue. But watching portfolios slide during forced liquidation tests conviction. Understanding the mechanics helps. This isn't the market rejecting silver. It's index rules creating a temporary distortion. Sophisticated participants in commodity markets recognize these events. They prepare, some position to profit from the volatility. Others simply wait, knowing the forced selling is finite 7 days. That is how long the rebalancing window stays open. On January 15th, the mandatory selling ends. The index reaches target weights. Passive funds complete their rebalancing and the market returns to fundamentals. But between now and then, $5 billion must find buyers. In a market increasingly skeptical of extended rallies, in a market with reduced liquidity due to margin hikes, in a market where other selling pressures are simultaneously building. The forced liquidation mechanism is about to meet reality, and reality doesn't care. About index construction rules. It cares about supply and demand. About buyers and sellers, about the price where they finally agree to transact. That price discovery process begins January 8th. The index rebalancing doesn't operate in isolation. 5 separate pressure systems are converging on silver markets at the same time. Each one alone would create volatility. Together, they form something far more dangerous, a compounding cascade where selling triggers more selling, where weakness breeds additional weakness, where mechanical forces overwhelm rational analysis. Analysts call this a confluence event. The technical term fails to capture the reality. This is a perfect storm. The first pressure system emerged from an unexpected source tax calendars. Silver delivered 148% returns in 2025. Investors sitting on those gains faced a critical decision in late December. Sell before December 31st and pay short-term capital gains tax rates. Or hold through year-end and qualify for lower long-term rates. The math favored waiting. Short-term capital gains are taxed as ordinary income, with rates reaching 37% for high earners. Long-term rates top out at 20% for large positions. That gap represents millions of dollars. So investors held. They entered 2026 with massive unrealized gains still intact. But tax deferral is not tax elimination. Those positions will eventually be sold, and the historical pattern is clear. The first 2 weeks of January often bring concentrated profit-taking. Investors who postpone selling for tax reasons typically execute in early January. The volume of this selling is hard to quantify precisely, but market historians note the pattern repeats year after year. After strong years, January selling accelerates. After exceptional years, like 2025, it can be substantial. This tax-driven selling will hit markets during the exact window when index rebalancing occurs January 8th through 14th. The overlap is coincidental. The impact will not be The second pressure system sits in currency markets. Throughout 2025, the USD dollar weakened significantly, down over 6% for the year against major currencies. Dollar weakness mechanically supports commodity prices. Commodities are priced in dollars globally. When the dollar falls, commodity prices often rise to maintain purchasing power parity. Silver benefited enormously from that dynamic in 2025. But currency markets don't move in straight lines forever. In late December, the dollar began to reverse. Ease F2. GDP data for the third quarter showed robust economic growth better than expected. Better than most major economies. Currency traders responded predictably. They bought dollars. The move accelerated in early January. Technical analysts noted the dollar had reached oversold conditions after its 2025 decline. Mean reversion was overdue. Now it is happening. A stronger dollar creates mechanical pressure on dollar-denominated commodities. Silver is particularly vulnerable, unlike gold, which functions primarily as a monetary asset. Silver has substantial industrial demand, and industrial demand is economically sensitive. A strong dollar often correlates with weaker economic conditions in emerging markets. Those markets represent significant industrial silver consumption. This currency headwind adds to the forced liquidation headwind. The third pressure system came from the exchanges themselves. On December 29th, CME Group announced margin requirement increases. Effective immediately, traders must now post 17% of contract value. This marks the highest margin requirement in silver's modern trading history. Even during the 2011 crash, margins only reached 10%. Why did the exchange act officially to ensure market stability during anticipated volatility? Unofficially, because they see what's coming. The index rebalancing is public knowledge. The tax selling pattern is historical fact. The exchange prepared for the convergence. But margin hikes create their own pressure. Traders operating with leverage suddenly face a choice: post additional capital to maintain positions, or close positions to meet margin requirements. Many lack the additional capital. Others choose not to deploy it. The result is forced position closure. Leveraged long positions get liquidated. That selling adds to the index-driven selling. It compounds the tax-driven selling. The layers stack on top of each other. The fourth pressure system is purely technical. Silver's chart entering 2026 showed extreme readings. The relative strength index hit levels associated with severe overbought conditions. Moving averages diverged dramatically. Momentum indicators flashed warning signals. Technical traders rely on these tools. When multiple indicators line up, they act. Selling began based purely on chart patterns, not on fundamentals. Not on news, simply because the technical setup suggested a correction was overdue. Algorithmic trading systems amplified the dynamic. Modern markets involve substantial automated trading. Algorithms watch technical indicators continuously. When certain conditions are met, they execute automatically. No human judgment. No fundamental analysis, just programmed responses to mathematical triggers. As silver's indicators deteriorated, algorithms began selling. That created a feedback loop. Selling pushed indicators further into negative territory, which triggered more algorithmic selling, which worsened the indicators further. Technical analysis became self-fulfilling. The fifth and final pressure system involves a second index entirely. The S&P GSCI Commodity Index family also rebalances in January. Their execution window runs January 8th through 15th, nearly identical to Bloomberg's timeline. The S&P GSCI represents additional billions in passive commodity investments. Their rebalancing requirements differ from Bloomberg's different target weights, different calculations, different mandatory adjustments. For some commodities, the two indices move in opposite directions. Bloomberg buys cocoa while S&P sells it, creating cross-currents. For silver, both indices require selling. The direction aligns, the pressure compounds. Multiple passive fund families dumping simultaneously. This creates a situation market veterans describe with concern. Not fear, not panic. Concern, because they understand what happens when multiple forced sellers hit a market simultaneously, with limited buyers willing to absorb the flow. Price discovery becomes violent. The normal negotiation between buyers and sellers breaks down. Sellers can't wait for reasonable bids. Their mandates require execution within the window. Buyers recognize the desperation. They lower their bids. They force sellers to accept unfavorable prices. This is not a free, market-finding equilibrium. This is a distorted market where mechanical selling overwhelms organic demand. Each of the 5 pressure systems alone would create elevated volatility. Tax selling happens every January. Markets handle it. Dollar strength occurs periodically. Commodities adjust. Margin hikes come and go. Traders adapt. Technical corrections are routine normal market function. Index rebalancing is annual, anticipated, and managed. But all 5 simultaneously during the same 7-day window. This is unprecedented in recent silver market history. The 2011 crash provides only a partial comparison. Margin hikes and technical selling combined then, but not index rebalancing of this magnitude. Not tax-driven selling after a 148% gain. Not S&P and Bloomberg selling at the same time. The compounding effect creates exponential rather than additive pressure. 1 + 1 becomes 3, and cascading liquidations. Selling triggers stop losses. Stop losses trigger more selling. Algorithms detect the move and pile in. Market makers widen spreads as the wave approaches. Wider spreads discourage buyers. Fewer buyers means sellers must accept worse prices. Worse prices trigger more stop losses. The cycle accelerates. Market participants watching this setup reach different conclusions based on their time frames. Short-term traders see danger. Intermediate traders see chaos. Long-term investors see opportunity. Because beneath all 5 pressure systems, nothing fundamental has changed. The supply deficit persists. Mine production continues to decline. Industrial demand keeps growing. The reasons to own silver long-term remain intact. But markets don't care about long-term fundamentals when short-term mechanics take control. Between January 8th and January 14th, mechanics will dominate. The perfect storm doesn't ask permission. It simply arrives. A peculiar situation develops when market price disconnects from underlying value. Traders watch screens. Industrialists watch supply chains. One sees numbers falling. The other sees shelves emptying. Both are looking at the same metal. Yet they are living completely different realities. The forced liquidation beginning January 8th may move prices dramatically, but it won't change a single fundamental fact about physical silver markets. Understanding this disconnect separates those who profit from chaos from those who become its victims. Deep beneath the surface noise of index rebalancing and margin hikes, a structural crisis is intensifying. Global silver production peaked in 2016 at approximately 900 million ounces. Since then, output has declined every single year. 2025 ended with production around 800 million ounces. That is 100 million fewer ounces extracted from the earth each year. A 12% reduction. The reasons are economic rather than geological. Silver deposits still exist in abundance, but decades of artificially suppressed prices destroyed the economics of exploration. Mining companies stopped searching for new silver deposits. They redirected capital toward gold and copper. They closed marginal silver mines. They reduced investment in expansion projects. The pipeline of future supply dried up. Discovering a new silver deposit requires years of exploration. Proving that deposit is economically viable requires more years of drilling and testing. Obtaining permits to actually mine requires additional years of regulatory process. Building the mine and processing facilities requires years of construction. From initial discovery to first production, the timeline averages 10 years minimum. That assumes everything proceeds smoothly, no permit delays, no community opposition, no technical complications, no cost overruns. The silver needed in 2026 should have been discovered in 2016. It wasn't. The price signals were wrong. Suppressed prices told the market that silver exploration wasn't economically justified. The market responded rationally to false signals. Now, in early 2026, the consequences are showing up. Production can't increase quickly, regardless of price. The mines simply don't exist yet. Meanwhile, on the demand side, acceleration continues. Industrial consumption reached 550 million ounces in 2025, and that number is climbing. The solar industry alone consumed 290 million ounces last year. Industry projections show 450 million ounces required by 2030, a 55% increase in just 5 years. With today's technology, silver is effectively irreplaceable in solar panel manufacturing. The photovoltaic cells that convert sunlight into electricity rely on silver's unique properties, the highest electrical conductivity of any element, the highest thermal conductivity, and the highest reflectivity. No substitute matches all three. Scientists are researching alternatives. Copper shows promise in certain applications, but retooling entire manufacturing processes takes years, and even partial substitution tends to occur only above certain price thresholds. Industry analysts estimate solar manufacturers can absorb silver prices up to $134 per ounce before substitution becomes economically necessary. With current prices around $72 per ounce, the margin is enormous. The solar industry will keep consuming silver even if prices double from here. Electric vehicle production adds another demand engine. Each EV contains more silver than traditional vehicles. Advanced driver assistance systems require silver. Battery management systems use silver contacts. Charging infrastructure depends on silver components. As global EV adoption accelerates, silver consumption rises with it. Fifth-generation wireless infrastructure adds yet another stream. 5G networks require silver for signal integrity. The higher frequencies used in 5G demand materials with superior conductivity, and silver outperforms the alternatives. As telecom companies build out 5G globally, silver usage increases. Medical applications continue expanding as well. Silver's antimicrobial properties make it essential in wound dressings, surgical instruments, medical device coatings, and hospital infection control systems. An aging global population pushes medical silver demand higher. Each of these industrial sectors operates with long procurement cycles. Companies don't buy silver spot. They contract months or years in advance. They need supply certainty. Price matters less than availability. This creates unusual market dynamics. Even as futures prices decline due to forced liquidation, physical premiums can rise and industrial buyers can become more aggressive. They view the forced selling as temporary. They view their supply needs as permanent, and they act accordingly. Evidence of physical market stress already existed before the rebalancing announcement. The silver futures market showed backwardation, meaning spot prices exceeded futures prices. Normally, futures trade at a premium to spot because of storage costs, insurance, and the time value of money. These factors make future delivery more expensive than immediate delivery. Backwardation is the opposite. The market pays a premium for silver now versus silver later. That only happens when immediate supply is genuinely tight, when holders of physical metal refuse to sell at futures prices, and when industrial users compete aggressively for available inventory. The backwardation signal appeared before the forced liquidation. It reflected an underlying physical shortage. Lease rates told the same story. The cost to borrow silver rose substantially throughout 2025. High lease rates signal tight supply. Holders of physical silver demand higher compensation to lend their metal because they fear they won't be able to get it back when needed. Tightness was not theoretical. It was visible across multiple physical market indicators. London Bullion Market Association vaults. Historically, the deepest pool of available silver showed declining inventories. COMEX warehouses in New York reported similar patterns. Available stocks were being drawn down, not replenished. Shanghai experienced even more dramatic tightness. Reports emerged of extended wait times for physical delivery. Premiums over spot prices widened significantly. Some dealers stopped taking new orders entirely. Then, China implemented export restrictions. In January 2026, new licensing requirements took effect. Only 44 approved firms can export silver from Chinese territory, each required to meet minimum production thresholds. This effectively blocks roughly 60% of Chinese refined silver from world markets. China is reserving supply for domestic solar, electronics, and advanced technology industries. The United States government recognized silver's strategic importance. In 2025, silver received critical mineral designation, acknowledging its necessity for national security and economic stability. The designation enables policy responses including tariffs, incentives, and strategic stockpile considerations. However, policy actions take years to influence physical supply. They cannot resolve immediate shortages already present in the market. The disconnect between price action and physical reality creates rare opportunities. Sophisticated industrial users recognized this during 2025. Major electronics and solar manufacturers secured multi-year supply contracts, willingly paying premiums for guaranteed availability. They understood that when physical shortages emerge, price becomes secondary. Inability to source silver halts production entirely, making higher prices preferable. The investment community is slowly recognizing this dynamic. Exchange-traded funds holding physical silver saw substantial inflows during 2025 as investors favored allocated metal over paper exposure. Physical investment demand now compounds industrial demand. Unconfirmed reports suggest some central banks explored silver allocations. If confirmed, this adds price insensitive. Strategic demand competing for already limited supply. The 6-year supply deficit tells the ultimate story. From 2020 through 2025, demand exceeded production every single year. The cumulative deficit approaches 2 billion ounces. That shortage was filled by drawing down above-ground stocks. Recycled material, strategic reserves, but stocks are finite. They shrink with each year of deficit. Eventually, no inventory remains to fill the gap. At that point, only three outcomes exist: demand destruction through much higher prices, supply increases through new mine production, or system failure, industrial users unable to source required material. The forced liquidation beginning January 8th changes none of this. Index rebalancing does not create new mine supply. Margin hikes do not reduce industrial consumption. Tax-driven selling does not eliminate the structural deficit. The price may decline, potentially sharply, but the fundamental imbalance intensifies regardless of price action. This is the reality beneath the chaos. The 7-day window between January 8th and January 14th represents more than a set of dates. It represents a test of conviction for investors, a test of strategy for traders, a test of preparedness for industrial users. Mining companies face the most visible challenge. Their stock prices trade with high correlation to the underlying metal. When silver falls, mining stocks typically fall harder. The leverage works both ways. During rallies, mining equities outperform the metal. During declines, they underperform. This creates a communication challenge for management teams. How does a CEO explain a 20% decline when fundamentals didn't change? The operational reality remains unchanged, ore grades are stable, production costs are controlled, demand for output is strong, yet market capitalization evaporates during forced liquidation events. Sophisticated executives prepare in advance. Explain rebalancing mechanics, maintain capital discipline, and resist hedging at temporarily depressed prices. Those with balance sheet strength endure. Excessive debt raises lender pressure. Covenant violations become possible if metal prices fall far enough. Cash reserves provide flexibility to withstand short-term volatility without forced actions. Industrial consumers face the opposite setup. For them, forced liquidation represents opportunity. Procurement managers watch closely. Their companies need consistent supply. Interruptions halt production lines, idle workers, and stop revenue. So, supply certainty matters more than price. But when mechanical selling creates a temporary price depression, forward purchasing becomes attractive. Locking in 6 months or 12 months of supply at forced liquidation prices reduces input costs that flow directly to profit margins. The challenge is execution timing. Place orders too early on January 8th, and prices may fall further by January 14th. Wait too long, and the liquidation ends with prices recovering. Sophisticated procurement teams often split purchases 1/3 on January 8th, 1/3 on January 11th, 1/3 on January 14th. This averages the entry price across the liquidation window. It removes the pressure of timing the exact bottom. It ensures supply security while capturing favorable pricing. Solar panel manufacturers exemplify this approach. Their silver consumption is massive and growing. Supply interruptions are unacceptable. Their break-even analysis shows they can absorb silver prices up to $134 per ounce. Current prices, around $70, leave enormous margin. Even if forced liquidation drives prices to $60, their economics remain robust. They view the rebalancing as a gift, an opportunity to secure critical inputs at temporarily suppressed prices. For long-term investors, the situation demands intellectual honesty. Why did they buy silver initially? If the thesis was a fundamental supply-demand deficit, that remains intact. If the thesis was monetary debasement protection, that intensifies. If the thesis was industrial demand growth, that accelerates. Nothing about forced liquidation invalidates these rationales. Yet human psychology struggles with portfolio volatility. Watching unrealized gains evaporate tests conviction. The temptation to sell and protect profits becomes overwhelming. This is precisely when understanding mechanics provides an advantage. The selling is mandatory for passive funds. It is temporary by definition. The 7-day window closes on January 14th. After that, the forced sellers are done. The market returns to organic supply and demand dynamics. Investors who hold through the volatility typically benefit. Those who sell during forced liquidation often sell to sophisticated buyers who understand the mechanics. Wealth transfers from those who react emotionally to those who think strategically. The pattern repeats across market history. Active traders face more complex decisions. For them, forced liquidation creates both risk and opportunity. The risk is straightforward: Attempting to catch a falling price can result in substantial losses. If liquidation accelerates beyond expectations, long positions suffer, stop losses trigger, margin calls arrive, positions get liquidated at unfavorable prices, but the opportunity is equally real. Systematic buying as forced sellers capitulate has historical precedent for success. The key is defined risk parameters. Traders who succeed during these events set clear rules before execution begins. They identify specific price levels where buying makes sense: $65 per ounce, 60美元, 55美元. They allocate capital at each level. They accept that prices might fall further after they buy. They plan for that possibility through position sizing. No single purchase carries excessive risk. Total exposure stays manageable. Equally important, they define the exit strategy in advance. The rebalancing ends January 14th. Forced selling stops. At that point, holding through further volatility makes less sense. The mechanical pressure is resolved. Any remaining weakness would reflect fundamental deterioration, not technical distortion. Traders must separate the two. Options strategies offer alternative approaches. Selling put options at lower strike prices generates premium income. If silver falls to the strike, the trader acquires exposure at a discount while keeping the premium. If silver never hits the strike, the premium is retained. This approach appeals to investors who already want silver exposure. Forced liquidation improves entry conditions. Physical silver buyers face unique considerations. Premiums over spot prices typically compress during forced futures selling. Dealers lower premiums to stay competitive as prices fall. The metal itself is unchanged. 1 ounce remains 1 ounce. But a $10 per ounce difference on large positions is meaningful. Physical buyers avoid margin calls and forced liquidation entirely. Once purchased and stored, physical silver simply sits. No exchange can issue margin calls. No broker can force liquidation. Volatility becomes irrelevant for holders without selling pressure. This stability contrasts sharply with leveraged paper positions. Forced liquidation affects paper markets first, while physical ownership remains insulated from technical selling and exchange-driven volatility. Corporate treasury departments must prepare communications. Chief financial officers face analyst and board questions as silver inventories mark to market. These are accounting adjustments, not realized losses. Understanding rebalancing mechanics allows confident explanation. Inventory value declined temporarily due to technical selling. The physical metal remains. Industrial utility is unchanged. Prices typically recover after forced liquidation ends. Risk managers must stress test scenarios before volatility arrives. What happens if silver falls 10% or 20%? At what price does the decline create operational challenges? Running scenarios ahead of January 8th enables proactive planning. Waiting until volatility begins creates reactive chaos. Preparation distinguishes disciplined organizations from those forced into rushed decisions under pressure. The substitution question resurfaces during every silver decline. Partial substitution with copper is technically possible in some applications, but only at much higher prices. Solar substitution becomes viable around $150, $200 per ounce. Electrical uses near $100. Medical applications resist substitution at any price. Current prices around $70 remain far below meaningful substitution thresholds. Timeframes matter. Manufacturing processes do not change overnight. Transitioning away from silver requires years of redesign, testing, and certification, and equipment changes. By the time substitution could occur, forced liquidation would be long past. Short-term price volatility does not alter long-term material choices embedded deeply in industrial supply chains. Geopolitical forces add another layer. China's export restrictions remain regardless of price. The yuan, his critical mineral designation, continues. Strategic resource competition intensifies. Western nations recognize supply vulnerability and dependence on foreign refining. Building domestic capacity takes years. Forced liquidation does not change these realities. Paper markets sell contracts, but they cannot sell metal that does not exist. The post-liquidation outlook depends on execution. If forced selling proceeds in an orderly way, prices might decline 10% to 15%, uncomfortable, but manageable. If forced selling triggers cascading stop losses and algorithmic amplification, prices could fall 25% or more, painful, but temporary. Historical precedent from 2011 showed a 48% decline, but fundamentals then were deteriorating. Current fundamentals are strengthening, not weakening. The base case suggests recovery begins shortly after January 14th. Industrial buying returns. Investment demand recovers. The supply-demand deficit reasserts itself. Prices climb back toward $80 to $90 by February or March. Forced liquidation becomes a memory, a temporary distortion that created opportunity.